Gold didn't just break higher overnight. This was a warning flare, and a lot of powerful money wants you to believe it. Just another fear spike. Because if it isn't T, their playbook changes fast. And I'm going to show you the hidden mechanism that tells you whether this move has a second leg in the next 1 to 2 weeks. What level matters most, and what breaks in the market's math if gold refuses to give that level back. The headline version is simple. Safe haven flows jumped, risk got weird, and gold did what gold does. But the market version is not that simple, and that's exactly why it moved the way it did. When you get an overnight jolt that shoves price through a psychological ceiling, right through the kind of number that traders love to sell, because it's obvious, you're usually not watching a crowd of retail buyers politely lifting offers. You're watching a structure adjust. You're watching someone who can't afford to be wrong become a buyer at the worst possible time. And you're probably watching liquidity thin out just enough that the adjustment happens in a burst instead of a crawl. That's the conflict right now. One side wants to frame this as emotional and temporary. The other side is pricing it like a structural bid that has to be respected. And the difference between those two stories is not a vibe. It's plumbing, it's spreads, it's the curve, it's hedging. It's how risk gets warehoused when the market is forced to reprice safety in real time. Let's anchor what overnight jolt actually means in price terms, without turning this into a slow history lesson. Gold pushed into fresh record territory around the $4,600 area per ounce, with reports of spikes above that level during the session. That's not a casual move. That's not a normal day. So that's a move that forces every institution with a model, a risk limit, or an options book to touch the keyboard. And when the market is already leaning one way, when positioning is already tense, those moments don't just move price, they change behavior. People stop debating whether gold is too high. They start debating whether they can afford not to own it. And that's where the real pressure starts. Now, why would anyone want to suppress the meaning of this move? Not in the cartoon sense, not in the secret cabal sense, in the incentive sense. Because if this is a temporary headline panic, then funds can fade it, dealers can sell volatility, allocators can stay underweight, and the whole system can go back to treating gold like a side bet. But if the move is telling you that policy credibility is wobbling, that geopolitical risk is climbing, and that the market is starting to price a longer duration inflation risk premium, even quietly, then gold isn't a side bet anymore. It becomes a core hedge that forces uncomfortable decisions. It forces rebalancing. It forces career risk. And it forces some very expensive hedging in places most viewers never see. The next detail is what flips the whole setup. Here's the hidden detail that matters. Gold can rally for two completely different reasons, and both look identical if all you do is stare at the spot price chart. Reason one is the obvious one. Risk-off flows, safe haven demand, the dollar softens, yields ease, gold pops. Reason two is more mechanical and more dangerous for shorts. The market starts to treat near-term access to metal and near-term hedging protection as more valuable than deferred exposure, and that shows up first not in the headline price, but in the curve and the spreads. This is where most people get lost, because gold is a store of value, sure, but it also trades like a financing instrument. Gold has carry, gold has leasing, gold has a futures curve that, in normal times, tends to reflect the cost of funding and storage. When stress hits, that neat story can bend. And when it bends in a particular way, when the near-dated market gets tight relative to later delivery, price can go vertical in bursts, because the paper market is suddenly being asked to deliver certainty, not just exposure. But that's not the part that matters. The part that matters is what it forces participants to do. Think of the market as two intertwined arenas. One arena is paper. Futures, options, forwards, swaps, contracts that give you exposure and can be cash settled or rolled. The other arena is physical. Real bars, real delivery, real logistics, real vaulting constraints, real refinery schedules, real sourcing, and very real, not for sale, inventory that exists but cannot be coaxed out without paying up. When everything is calm, paper and physical are tethered by arbitrage. If paper runs cheap relative to physical, someone buys paper and sells physical or moves metal into the deliverable stream. If paper runs rich, someone sells paper against physical inventory. In other words, price discovery behaves. But when uncertainty spikes, especially uncertainty that touches policy credibility, war risk, and currency confidence, physical demand doesn't just ask, what's the price? It asks, can I get it, and can I hedge the risk of not having it? That's when spreads, lease rates, and near-term hedging demand can do the talking. And that's where the market stops being polite. So what actually triggered the jolt? The broad narrative out there is a mashup. Geopolitical tensions flaring and renewed anxiety around central bank independence, political pressure, policy credibility, questions, the kind of situation that makes investors wonder whether rates will be held down while inflation risk quietly rises. That combination is basically rocket fuel for the debasement hedge trade. Even if you don't buy the dramatic framing, you don't need to. Markets trade incentives. If participants believe policy could be influenced, the distribution of future outcomes widens. Wider outcomes mean higher implied volatility. Higher implied volatility means higher hedging costs. Higher hedging costs mean dealers have to manage risk more aggressively, and that can feed directly into spot and futures price action. This move isn't emotion, it's math. Let's talk about that math in plain language, because it is one of the cleanest mechanisms you can actually use to forecast what comes next, without guessing headlines. Options dealers, market makers, often end up on the other side of customer option trades. When customers buy calls as protection or speculation, dealers may be short those calls. Being short calls means your risk grows as price rises because you owe more and more convexity. To manage that, dealers delta hedge. They buy the underlying, or futures, as price rises and sell as price falls, trying to stay neutral. The key is gamma. When gamma is high and dealers are short gamma, rising prices force them to buy more into strength. That's reflexive. That's how you get that it keeps going even when it feels stupid behavior. And when liquidity is thin, like it often is in overnight sessions or around calendar windows, the forced buying doesn't get absorbed smoothly. It gaps, it jolts, and that's where the real pressure starts. Now let me pin the calendar to the wall, because why now is never optional in a move like this. We are sitting in a window where two things tend to collide: month-end behavior and options behavior. Toward the end of the month, large funds rebalance. If equities wobble and gold surges, the math of portfolio weights changes. That creates mechanical flows, selling what went up the most, buying what lagged, or in risk-off environments, increasing hedges rather than trimming them depending on the mandate. Layer on top the options calendar. Late January is an important window for gold options in the major venues. The closer you get to expiration, the more sensitive hedging can become around key strikes. You don't need to know every strike, you just need to understand the principle. As expiration approaches, hedging demand can concentrate around the levels that have the most open interest, and price can get pulled toward them, then slingshotted away if it breaks. The calendar is the catalyst, not the backdrop. And if this one level breaks, the math changes. So let's build the proof stack the way professionals do it. Multiple layers, different data types, different markets, because relying on one argument is how you get emotionally hacked. Proof point one is macro, the dollar and real yields. Gold is famously sensitive to the opportunity cost of holding a non-yielding asset. When real yields fall, gold tends to benefit. When the dollar weakens, gold tends to benefit. And in stress events, you can get both. Money moves out of risk, expectations shift toward easier policy, or at least toward more uncertainty around policy, and the dollar can soften as investors hedge. The key is not rates down equals gold up. The key is the change in expectations and the volatility of those expectations. Even if nominal yields don't collapse, the perception that policy may be pressured can lift inflation expectations. That narrows or reverses real yield support. And gold doesn't need perfection, it needs a tail risk bid. Proof point two is volatility itself. People talk about volatility like it's a weather report, but in markets like gold, volatility is a participant. When implied volatility rises, option premiums rise, hedging costs rise, and dealers adjust their books. That adjustment often means buying futures on rallies and selling them on dips in a way that amplifies the move. So if you saw gold jump and you also saw a vol bid, that's not a coincidence. That's the engine. Because the market isn't just repricing gold, it's repricing the distribution of outcomes. And when outcomes widen, gold gets treated less like a commodity and more like insurance. But that's not the part that matters. The part that matters is what it forces others to do. Proof point three is institutional flow behavior. The loud story is always people bought gold. The useful story is which people bought and why. Retail can move coins and small bars. Institutions move the benchmark. When ETFs see inflows, when model portfolios rebalance, when macro funds rotate into commodity exposure or currency hedges, the flow can start as a whisper and then turn into a roar because it's persistent. It doesn't stop after the first headline. It continues as long as the narrative threatens the credibility of the currency regime. If global gold ETFs are seeing meaningful net inflows, that's a sign the bid is not just a panic spike, it's allocation behavior. And allocation behavior is slower, heavier, and more stubborn than a day trade. The next detail is what flips the whole setup. Proof point four is global physical signals. And this is where the metals crowd should lean in, because physical markets don't care about Twitter arguments. Watch premiums. Watch regional pricing versus the benchmark. In many cycles, the most telling sign that a move has depth is that physical demand remains firm even after price jumps. If premiums in major consuming regions remain elevated, that means buyers are not just chasing price, they're securing supply. And when that happens, arbitrage becomes a magnet. Metal gets pulled from one region to another. Logistics and vault flows respond. That tightens availability in the places that set paper prices, and it shows up in the curve and the spreads long before it shows up in mainstream commentary. Proof point 5 is inventories and deliverability, one of the most misunderstood topics in all of commodities. People see inventory and assume it's a pile of metal ready to be sold. In reality, inventory is categorized. Some inventory is deliverable, some is registered for delivery, some is eligible but not committed, some is earmarked, some is collateral, some is there, but not really available at any price that makes sense to the paper market. So you can have a world where reported vault stocks don't scream shortage, and yet the market behaves tight because the effective float is constrained. In other words, the metal exists, but it's not coming out without a premium. And when the paper market needs it to come out, because delivery risk matters during stress, that's when the tension shows up in spreads and financing rates. That's the hidden detail. The price is one line on the screen. The availability of certainty is a different line, and it often moves first. Now let's pull these threads back into the overnight behavior, because the timing tells you who was forced. Overnight jumps tend to happen when liquidity is thinner and when participants who can't wait for better prices have to act. That includes dealers hedging options, exposure as price rips through strikes. It includes short sellers forced to cover because their margin models don't care about their opinion. It includes funds that run volatility targeting, where rising vol forces de-risking elsewhere and sometimes forces hedges to be increased. It includes global macro portfolios that rebalance away from equity beta and into real assets when the distribution of outcomes widens. And it includes corporate or sovereign players who treat gold as a reserve hedge, not a trade. The move doesn't need one villain, it needs one constraint. When constraints tighten, markets jump. Because if you can't get size done without moving price, price moves until size gets done. So where do we go from here? And how do we keep this finance credible instead of turning it into hype? We name the levels, and we name the scenarios before the volatility tries to name them for us. Let's start with the most important psychological and structural zone, the area around $4,600. Big round numbers matter because they cluster behavior, they cluster stop orders, they cluster option strikes, they cluster sell because it's obvious trades. When gold breaks a number like that and holds above it, it's not just a win for bulls, it's a problem for anyone who sold calls, anyone who shorted the breakout, and anyone who anchored their risk model to the idea that gold can't sustain that level. If gold can't hold it, if it pops above and then quickly bleeds back under with volatility collapsing and the curve relaxing, that's your signal. The jolt was mostly emotional and positioning driven. But if it holds, retests, and buyers show up again, that's where the second leg becomes likely. Because then it's not a spike, it's acceptance. And acceptance is what forces the slow money to chase. Now the two scenarios, because this is how you keep your head when the market tries to shake you out. Scenario 1 is the controlled pullback and retest. Price surges, everyone gets excited, then the market breathes. Gold drifts back toward the breakout zone, maybe mid 4,500s, maybe toward the low 4,500s, depending on the day's volatility. And it tests whether demand is real. In this scenario, you want to see dips bought without panic, implied volatility staying firm, and the plumbing signals not fully relaxing. That means the front part of the curve doesn't suddenly cheapen relative to later months. It means physical indicators don't collapse. It means the dollar doesn't rip higher in a way that punishes all commodities. If that happens, the market has built a base at a higher altitude. That's bullish, even if it feels boring. Scenario 2 is the continuation squeeze. And this is the one that burns people because it comes with gap risk. In this scenario, the market doesn't give you the polite retest. It keeps grinding higher, often in ugly steps, because dealers keep hedging, shorts keep covering, and fear keeps showing up in the places that matter. Currency hedges, vol markets, and allocation flows. This is where you can get a move that looks unreal on the chart, followed by sharp intraday reversals designed to punish late longs. And this is where you need the viewer psychology shield, because the market will try to emotionally manipulate you into doing the wrong thing at the wrong time. The next detail is what flips the whole setup. Here's that shield, and it's not motivational fluff, it's tactical. Volatility has a job. Its job is to make you confuse noise for signal. The market will use headlines to justify the whip, but the whip often comes from structure. Stop runs, options hedging, liquidity vacuums, and the simple fact that in a fast market, dealers widen spreads and pull bids. That creates air pockets. If you chase green candles, you become the liquidity. If you panic sell red candles, you become the liquidity again, on the wrong side. The trick is to decide in advance what matters. Trend signal versus noise. Trend signal is, does price hold the breakout zone on a closing basis? Do the plumbing indicators confirm tightness or persistence? Does the macro backdrop continue to support the risk premium? Noise is intraday spikes, headline whipsaws, and the emotional urge to treat every pullback as the end of the world or every pop as the start of a straight line moonshot. So let's define what would actually confirm this thesis in the next week or two, and what would weaken it. Confirmation looks like a checklist, not a vibe. First, watch the dollar. If the dollar remains under pressure, or at least fails to reclaim momentum, gold has oxygen. If the dollar surges aggressively, that's a headwind and a warning that the jolt could fade. Second, watch real yields and inflation expectations. If break-evens stay firm or rise while nominal yields aren't screaming higher, the real yield backdrop stays supportive. If real yields pop higher sharply and stay there, gold can still rise in a geopolitical panic, but it becomes harder. Third, watch implied volatility in gold options. If vol stays bid, dealers stay active and reflexivity stays alive. If vol collapses, a big part of the engine shuts off. Fourth, watch the front versus back behavior in gold futures. You're looking for whether near-term pricing remains tight relative to deferred, whether the market is paying up for immediacy. If that tightness relaxes quickly, the hidden detail is fading. Fifth, watch physical signals. Premiums, availability chatter, the willingness of buyers to keep paying up after a jump. If physical demand vanishes, the second price spikes, the move is more paper than substance. If physical demand persists, it supports the idea that this is not a one-day story. Now, targets, because people want numbers, and we can talk levels without pretending we can predict the future to the dollar. If gold is building acceptance above the $4,600 region, the next psychological zone becomes the next big round band above it, and markets often travel between these magnets faster than people expect when stress is high. But targets only matter with invalidation. So here's the more important part. What would invalidate or seriously weaken the thesis? A clean failure back below the breakout zone, back below that $4,600 area, and then follow through selling that drags price into the mid 4,400s without buyers defending it, combined with a noticeable cooling in vol and a normalization of curve, sosh, spread behavior, would tell you the market has decided the jolt was temporary. That doesn't mean gold is dead. It means the immediate squeeze dynamics have deflated. It means the market is not being forced anymore. And if the market isn't forced, it can drift, chop, and punish impatience. Because if this one level breaks, the math changes. Let's also address the skeptical institutional angle, because the audience here includes people who don't trust narratives. Skeptics are right to ask, isn't gold already crowded? Isn't it too obvious as a safe haven? And the answer is, it can be both obvious and still under-owned by the mandates that matter. Crowdedness is not a feeling. It's positioning relative to constraint. If global allocators are still underweight hard assets compared to the risk they're facing, the trade can keep going even if it's obvious, because the constraint is that they must hedge. And when they hedge, they don't do it with a tweet. They do it with size. But here's the counterpoint you must respect. If the stress narrative fades quickly, if geopolitical fears cool, if policy credibility fears ease, if the dollar regains strength, if real yields reassert, gold can whip violently lower, even if the long-term thesis remains intact. This is why you never confuse thesis with path. Price can whip around violently even if you're right on direction. That's not a bug, that's the system. Now let's talk about the paper versus physical discussion the right way, because this is where people get reckless. It is absolutely true that paper markets can dominate price discovery in the short run. It is absolutely true that physical tightness can show up in places the mainstream doesn't watch. But you don't need to claim illegal manipulation to understand what's happening. The incentives are enough. Banks, dealers, and funds manage risk. They sell volatility when they're comfortable. They buy it when they're not. They hedge when their models demand it. They reduce exposure when VAR spikes. They widen spreads when liquidity thins. None of that requires a conspiracy. It produces the same outcome. When stress hits, the market can gap and force behavior. And that forced behavior can look like someone is doing something. In reality, the system is doing what it was designed to do. Transfer risk from the unprepared to the prepared at a price. That's where the real pressure starts. So what should a finance-minded retail investor actually do with this information, besides feel hyped or terrified? You use it to stop being emotionally farmed. You stop treating gold like a lottery ticket and start treating it like a regime indicator. You ask, is the market repricing safety because of a temporary scare or because the policy and geopolitical regime is shifting in a way that changes the long-term distribution of outcomes? The hidden detail, curve behavior, and hedging pressure helps answer that. You watch the calendar window into late January. You respect the possibility of both scenarios. You avoid oversized bets that force you to sell at the bottom of a whip. You decide what level matters for you based on your horizon. Traders care about the breakout zone and the retest. Longer-term holders care about whether the macro and credibility backdrop continues to justify a higher floor. And everyone should care about not letting headlines dictate their actions in a market that is structurally designed to amplify emotion. If you want a concrete next week roadmap, here it is in plain language. If gold stays above the breakout area near $4,600 and volatility remains firm, assume the market is still in forced flow mode and respect upside continuation risk, including gaps. If gold pulls back toward the breakout zone and holds, that's constructive. And it sets up the possibility of another push as month-end and options dynamics compress. If gold loses the breakout zone decisively and the supporting signals, VVOL, dollar weakness, curve tightness, physical firmness, fade at the same time, downgrade the immediate squeeze thesis and expect chop, mean reversion, and emotional traps. The market will try to make you buy the top and sell the bottom. Don't volunteer, but that's not the part that matters. The part that matters is that you now know what to watch. You are no longer dependent on the loudest headline to tell you what the move means. And one more thing, because it's the quiet part that professionals keep in mind. When gold makes a record and does it with speed, it changes collateral behavior. It changes hedging preferences. It changes how people think about currency risk. It also changes how volatility gets priced across the metals complex. Silver can overreact. Miners can gap. Correlated assets can get dragged around by cross-hedging. That creates opportunities, but it also creates traps. If you're going to participate like someone who understands the game. Define your horizon. Define your invalidation. Size so you can survive the whip. And remember that the market's favorite trick is to make you feel late right before it rips, and to make you feel safe right before it snaps. If you're still listening, you are the kind of person who doesn't need permission from mainstream narratives to follow the money and the mechanics. That's the whole edge. So here's the subtle ask. If you want more of this style, mechanisms first, incentives first, and a real checklist instead of vibes, stick around. Because the next 2 weeks are the kind of window where gold can either cement a new regime or stage a violent shakeout that punishes anyone who did not plan for volatility. And if you want to contribute to the signal drop what you're watching most closely, the dollar, real yields, physical premiums, the curve, or the options tape, because the fastest way to build an unfair advantage is to compare notes with people who actually track the plumbing. Keep your eyes on that $4,600 zone, watch how price behaves around it on closes, and watch whether volatility and the front end of the curve keep leaning in the same direction. Because if they do, the market isn't done talking yet.